Hello everyone and welcome back to the revisionary classes on capital budgeting. This is the fifth part of these revision classes. Now over here we are going to talk about risk analysis in capital budgeting. Let me remind you, these are revisionary classes for the detailed concept videos. I have given you a list of videos. You can definitely watch those videos as and when required. Right now here we are focusing on quick revisions only. So when we talk about risk analysis in capital budgeting, we should know from where this risk is arising. What is the root cause of this risk? So basically, capital budgeting decisions are all long-term investment decisions, and these decisions are based on estimates of future cash flows. When you are making estimates of future cash flows today, there is no certainty that same amount of cash flows will arise in future. Today you are making some estimates, the estimates may go wrong. There may be lesser the amount of cash flows that may arise actually, or greater the amount of cash flows that may arise actually. That means there is no certainty associated with your decision. What is then associated with your decision is complete uncertainty. And when there is an element of uncertainty involved in the decision, your decision becomes risky. That means you are taking a decision, but there is risk involvement in your decision. Now, how to deal with this risk? Let me tell you one thing very clearly. This risk cannot be eliminated ever. That risk will exist because uncertainties exist. Can you knock off all the uncertainties from the future? You cannot do that, and therefore risk is going to exist in your entire decision. However, we can definitely learn how should we cope with this risk. So risk cannot be eliminated, but we can definitely learn how to manage that risk, or how should we cope with that risk. And therefore there are various risk management techniques under capital budgeting, and that is what we have to learn under risk analysis under capital budgeting. Now, all these risk management techniques have been classified into two categories: the conventional or traditional techniques and modern techniques or statistical techniques. Under modern techniques, you are using probabilities, you are involving concepts of standard deviation, coefficient of variation and all other statistical measures. You are going with decision tree approach. You are just making a decision tree and analyzing the possibility of each outcome and its probability and the final possible outcome on the basis of expected value of cash flow. On the other side, the traditional techniques do exist. These traditional techniques have lesser importance in reality today, but these traditional techniques also had been impactful, and conceptually understanding these traditional techniques also is important. From your examination viewpoint, both of these set of techniques are important. So let us quickly go through some important notes over here. You don't have to write these notes, but still if you prefer writing some notes, you can pause the video and definitely take note of the same. So we begin with this heading, risk analysis in capital budgeting, and here you consider this fact that capital budgeting decisions are based on estimations of future cash flows. Such estimations cannot be made with 100% certainty. In other words, lots of uncertainty is associated with such estimations. Such uncertainty leads to risk. Therefore, capital budgeting decisions are based on the fact of existence of risk and uncertainty. There are various ways for incorporating the risk associated at the time of taking a capital budgeting decision. So let us just move ahead and take note of what are these various methods and techniques. These are broadly classified into the following. One is conventional techniques and another will be modern techniques. Under conventional techniques, we have risk adjusted discounting rate technique, that is RADR technique. Then we have certainty equivalent technique, that is CE technique or CE approach. We have sensitivity analysis, also covering the concept of scenario analysis. Then we have next set of techniques classified as modern techniques or statistical techniques. Here we have probability approach, where we compute EVCF, that is expected value of cash flow, and ENPV, that is expected net present value. Then we have standard deviation and coefficient of variation. Then we have dependent and independent cash flows, and then we have decision tree approach, where we also talk about conditional probabilities. So once you are knowing that these are all the techniques that you have to learn, let us move ahead and discuss each one of these one by one, getting started with risk adjusted discounting rate, or in short RADR technique. Now let us try to understand what exactly is RADR technique, that is risk adjusted discounting rate technique. Now what is a discounting rate? It is basically an expected rate of return. This expected rate of return is basically investors' expectation from a risky project, correct? You are not investing into some kind of government bond which will give you a risk-free return. You are investing in a project which has lots and lots of uncertainty, too much of risk is involved. So obviously, the higher the degree of risk, more will be your expectation as an investor, more will be your expectation towards these returns. The higher the risk, the higher will be your expectation. So basically, the discounting rate is aggregate of two components, one that is considered as a risk-free rate prevailing in the market, and one is the component of the risk premium, that is basically reward to the investor for taking risk. So the risk premium, which indicates the reward to the investor for taking risk, added to the risk-free rate, the aggregate of these two components will definitely become a discounting rate, and that is where we call such discounting rate as risk adjusted discounting rate. So basically, risk-free rate for all the entities and all the projects will be same, but the degree of risk for all the projects will be different. So higher the degree of project, the higher will be the premium for the risk that is taken, and therefore the higher the degree of risk, the higher will be the risk adjusted discounting rate. So how do you apply this technique? Suppose there are three projects X, Y and Z, and suppose project X is the lowest risky project and project Y has a medium degree of risk, project Z is highly risky project. So when you are evaluating these three investment proposals, you are not going to apply a constant static discounting rate on all three. There will be common risk-free rate for all the three, but the risk premium will be different for all the three projects, and therefore the risk adjusted discounting rate will be lowest for project X, a little higher rate for project Y, and a substantially higher rate for project Z. The idea is very simple. Higher the degree of risk involved in any project, the higher will be the investor's expectation from that, and therefore higher should be the discounting rate. That is what we call as risk adjusted discounting rate. So let me quickly give you some notes on this and then we shall move ahead. So under this heading of risk adjusted discounting rate, you may consider these points. It has been discussed earlier that the cutoff rate is the aggregate of risk-free rate plus risk premium. For example, the risk-free rate is 10% and the premium for the risk involved in the project is 6%. Therefore, the risk adjusted discounted rate shall be 10 plus 6, that is 16%. Different projects involve different degrees of risk, and therefore RADR for different projects can be different. The basic idea in adopting this technique is to use higher discounting rate for higher risky projects on relative basis, so that there has to be higher expectation for returns for high risk involvement in any project. Let us move ahead, and now what we talk about is an example. For example, the company has to decide on selection of one of the two projects, that is A and B, which are mutually exclusive. Just recall that we have talked about mutually exclusive projects in our earlier classes. So if A and B are projects which are mutually exclusive, and further informed that project B is having more risk as compared to project A, the company adopts 12% per annum discounting rate for project A and 15% per annum discounting rate for project B. It can therefore be concluded that the project having higher risk should be analyzed using a higher discounting rate as compared to the project having lower risk. Now, for understanding this concept, please refer question number 7 from regular class videos. So friends, I'm sure you know one thing from the past videos, that all the required links for these videos I have given in the description. So you will definitely find the video link for this concept as well in the description. Let us move ahead, and now what we do is we talk about the application of capital asset pricing model. Now you would have read about this particular equation of capital asset pricing model, where ERX equals to RF plus RM minus RF into beta of X. Now what are these variables? Let us try to understand. ERX indicates the expected rate of return on project X as per capital asset pricing model. RF stands for risk-free rate, RM stands for rate of return on market portfolio, and beta of X is the beta factor for project X. Now what is the meaning of beta? We will talk about that sooner, and the detailed explanation of this CAPM model has been given in my concept videos. Again, the link of the same has been given in the description. Do watch that if you find it needful. Now let us talk about what is beta. Beta is a relative risk measure. It measures and indicates risk of a particular project in relation with the market. For example, if beta of project A is 1.2 times, it is understood that risk of the project, that is project A, is 1.2 times of the risk prevailing in the market. So the reference is given. Please refer question number 2 from regular class videos for developing complete understanding about this concept as well. So now let us move ahead and now talk about the next concept over here, that is certainty equivalent technique. We may also call it as certainty equivalent approach. Now this is a very thoughtful technique, very thoughtful approach. The believer of this particular technique, these set of thinkers, what they have concluded, that there is risk involved in the future cash flows, correct? So why don't we make risk adjustment in those future cash flows instead of adjusting the risk in your discounting rate? I told you it is thoughtful. When the risk is existing with the future estimates of cash flows, correct? Why don't you adjust those cash flows instead of adjusting the discounting rate? So under certainty equivalent technique, what is to be done? The future estimated cash flows which are uncertain amounts, you convert them into certainty equivalent cash flows, that is CECF. Let me give you one simple context. Your exam will be a paper of 100 marks. That means the maximum marks that you can score is 100 marks. Now if I ask you, do you wish to score 100 out of 100? You would obviously say, yes sir, I want to score 100 out of 100. But is there any certainty that you will score 100? No, there is no certainty that you will score 100. Is there any certainty that you will score 90? No, there is still no certainty that you will score 90. Is there any certainty that you will score 70? You will now stand up and say, yes sir, based on my preparation, I can assure you that 70 marks definitely I will score up. That means you are certain about scoring 70, you are uncertain about scoring 80, 90 and 100. So what we do is, your expected marks for you is 100 marks. That is a future expectation, and the certainty equivalent factor in your marks will be 0.7. So 0.7, when you apply to 100 marks, what you get is certainty equivalent marks. That will be 70 marks. 100 marks into 0.7, that will be certainty equivalent marks, that is 70 marks. Exactly in the same way, if I ask you how much cash flow are you expecting, you say that 10 lakhs. I ask you then that are you certain that you will be getting 10 lakhs? You will say, no, I am not certain that I will get 10 lakhs, but I am sure that I will be getting 8 lakhs of cash flow as minimum cash flow, nothing less than that. That means you have certainty of getting 8 lakhs of cash flow. We will call 8 lakhs of cash flow not as a certain amount of cash flow, but we will call it as certainty equivalent cash flow, CECF. Now, to compute the certainty equivalent cash flow, what will be informed to you? The estimated cash flow of 10 lakhs and the certainty equivalent factor as 0.8. So 10 lakhs multiplied by 0.8 will give you 8 lakhs of CECF, that is certainty equivalent cash flows. Now friends, when you are talking about certainty equivalent technique, keep in mind one thing: all your risk adjustment has been already made with the cash flows. Therefore, do not adopt a risk adjusted discounting rate for evaluating any proposal and computing NPV. For this purpose, you are necessarily required to adopt a risk-free rate as a discounting rate. Let me clarify this point, because sometimes ICAI may put traps in your examination questions. For example, they ask you to solve a question using certainty equivalent technique. So they will give you uncertain amounts of cash flows. They will also provide you information about certainty equivalent factors. So what you will do now, As I have instructed, you will multiply the respective amount of uncertain cash flows to the certainty equivalent factors, converting these cash flows into CECF, that is certainty equivalent cash flows. Now boss, you have already made the adjustment for risk. Now the question will inform you 2 lines below the cash flow information. They will say risk-free rate is 6% per annum. However, the risk class to which this project belongs would have a risk-adjusted discounting rate of 12% per annum. Now, shouldn't be fool to apply that risk-adjusted discounting rate over there, because you should consciously remind yourself that under certainty equivalent technique, you have already made risk adjustments with the cash flows. So the discounting rate that you adopt must be a risk-free rate. Let me quickly give you some notes over here and then we shall proceed ahead. So under this heading, certainty equivalent technique, you may write, this technique believes that uncertainty is associated with the future cash flows and therefore it is not appropriate to adjust the discounting rate. Instead, the future cash flows should be adjusted to certain cash flows or cash flows with certainty. This is done by multiplying factors known as certainty equivalent factors or CE factors. These factors can range between 0 and 1 in such a way that for higher certainty, a higher factor is adopted. Let us move ahead and notice things further. Application of this approach would result into similar conclusion as found under RADR technique, because for high risk, the certainty equivalent factors will be lower, which would ultimately reduce the present value of such expected cash flow. It should be noted that under this approach, the discounting rate should necessarily be the risk-free rate, because the element of risk has already been adjusted with the cash flows. Please refer question number 1 and question number 3 from regular class videos for developing complete understanding about this concept. Alright friends, let us move ahead and now talk about the next part, that is sensitivity analysis. Now this is a wonderful technique which is part of the conventional techniques, even though conventional technique, but it is one of my favorites. In fact, when you as a student start understanding sensitivity analysis in its entirety, you will start enjoying this technique as well. So what exactly is this sensitivity analysis? Whenever you are dealing with any capital budgeting decision, particularly when you are computing NPV of any investment, do you know there are 4 variables that are involved? One is the annual cash flow, that is the future cash flow. One will be the life of the project. Yet another thing will be the discounting rate. And then lastly, the cost of the project or the amount of initial investment. None of these are constant. All 4 are variables. So what if one thing changes? It will definitely impact your NPV. So today, when you are computing NPV of a project, you are suppose estimating cash flows of 10 lakhs every year. A question may arise, what if the cash flows are not 10 lakhs but 9 lakhs? So you first compute the NPV, making the calculations on the basis of original estimates of 10 lakhs. Then you recompute the NPV with a remeasured amount of NPV based on the cash flows of 9 lakhs. And then you will see what is the impact of changing the cash flows from 10 lakhs to 9 lakhs on your NPV. Means if cash flows are reduced from 10 lakhs to 9 lakhs, that means there is a 10% reduction in the annual cash flow. What will be the percentage change in your NPV? Here you have to observe one thing, that NPV may be directly proportional to certain factors and inversely proportional to certain factors. For example, if cash flow estimates are going to be greater than what you have expected, in other words, if cash flows what you are estimating and the actual cash flows turn to be greater than that, NPV will increase, right? So we don't fear about what if the cash flows increase. We are all the way very happy if the cash flows increase, but we have risk when the cash flows are declining. So when cash flows will decline, the NPV will decline. That means NPV has a direct relationship with cash flows. On the other side, if you relate NPV with the initial investment, the higher the initial investment, the lower will be the NPV. That means NPV is inversely related to the initial investment. Regarding life of the project, the higher the life of the project, the higher will be NPV, correct? In that case, NPV has a direct relationship with the life of the project. And the last factor that we should consider, the discounting rate. The higher the discounting rate, we have seen this in the earlier parts of the videos, that higher the discounting rate, the lower will be the present value. In other words, the NPV will have an inverse relationship with the discounting rate. So when we look into the impact of all of these changes over your NPV, we try to answer all the what if kind of questions. When I say what if kind of questions, somebody may ask you, okay boss, you are taking this decision based on estimate of cash flow of 10 lakhs every year. What if the cash flows reduce by 10%? What if the investment increases by 10%? What if the discounting rate changes? What if the life of the project reduces? Then all your questions of what if will be answered with even if only when you have made a complete analysis. For example, you have already made an analysis that if the cash flows reduce by 10%, that is from 10 lakhs per annum to 9 lakhs per annum, what will be the impact of the change of cash flows on NPV? Suppose you come to know that NPV is declining by 15%. Then you can say that even if the cash flows are declining by 10%, there will be still a positive NPV, because NPV is declining only by 15%. We will not be incurring loss. When you know what will be the impact of change of any particular information on your NPV, when you know it already, then dealing with the risk involved in that decision will be easy going. You know, some kind of cushion that you have in your decisions, that even if there is some adversity that we can face in future, even if that adversity is faced, we will be able to still survive with a positive NPV. We don't have to worry. That mindset that we don't have to worry is basically a psychological impact that will bring to this decision, and that is what we call as sensitivity analysis. The detailed discussion on sensitivity analysis is given in my concept videos. You should not miss it out and discover concepts of sensitivity analysis via question number 4 and 5 from regular class videos.